This podcast is brought to you by the School of Advanced Study, University of London.
Make an ongoing and hopefully substantial contribution to the intellectual, educational, vocational and academic underpinning of the bilateral relationship between New Zealand and the UK in what is quite a rapidly changing world. The Foundation is a registered charity and its trustees aim to forge lasting and important links between academics, policymakers, business leaders, researchers and others who are working at the cutting edge of their fields in each country. The Bling Foundation was launched in 2010 and that's when we launched the Visiting Professorship Program. Since then we've had three distinguished experts from diverse fields in New Zealand up here. So far this year we've had two visiting professorships, Emeritus Professor Anne Smith from the University of Otago, who visited earlier this year. She was an early childhood educationist and researcher in that field. And in recent times, and with us today of course, is the economist Professor Arthur Grimes, recent chair of the Reserve Bank of New Zealand. The New Zealand-UK Links Visiting Professorship Program was actually developed in collaboration with Sir Graham Davies when he was Vice-Chancellor of the University of London. And of course he's now our Foundation's chair. And in this we're also supported by Professor Philip Murphy, Director of that University's School of Advanced Study. Sir Graham is currently abroad and is very sorry that he can't be with us this afternoon. But we are particularly proud to be presenting Professor Arthur Grimes this year and to be associated with such a respected academic, policymaker, researcher and influencer in the field of monetary policy, a pioneer internationally of inflation targeting and respected in the theme of today's subject, governance and responsibility. And I can add my personal backing to those words in that I'm not a career diplomat. I've been in the New Zealand Parliament for 29 years. I entered the New Zealand Parliament the year the major economic reforms started in New Zealand. And so I've lived through, I've been a politician, including the Deputy Minister of Finance in New Zealand, through all the years that Professor Arthur Grimes has been such an influential thinker and such an influential New Zealander, especially as chair of the board of our Reserve Bank. Very quickly though, Professor Grimes will shortly be introduced by our chair, and he'll give you his keynote speech. Professor Ryder will also take you through the program for today, and the whole program should finish about 7 o'clock this evening. So it's quite a full program, and then there'll be drinks and refreshments after that, so please stay on for that. I think some New Zealand wine will be available for you to make for a pleasant discussion at the end of the whole thing. So ladies and gentlemen, can I now invite Professor Barry Ryder to introduce the main event this afternoon. Barry, thank you for having us here. It's great to have you chairing this afternoon. Forgive me, I have to leave to go to another function very shortly, but Professor Barry Ryder.
Before you do leave, let us thank you for being here and getting us started this afternoon, and in particular for the hospitality that you're going to extend to us at the reception this evening, which I'm sure will cement the relationship between the UK and New Zealand even more than Arthur's speech. Well, as the High Commissioner said, we've got a busy afternoon in front of us. The seminar this afternoon is headed Responsibility and Accountability in the Financial Sector. So I suppose if one was cynical, one would say it was going to be a very short seminar. Perhaps a triumph of hope over experience, but there we are. Obviously a very important topic. We are all aware of what has been happening to the financial sector, not just in the United Kingdom, but in many other parts of the world. And one of the issues that, of course, has arisen is to the extent to which there is responsibility and accountability in the conduct of financial business. It's very interesting because, of course, there is a very significant current debate on this. There are quite profound proposals being made. I was intrigued to see one attempted amendment of the bill that's going through Parliament by Lord Eatwell, where he's seeking to introduce a fiduciary relationship really right across the ring-fenced banks, or banks that are going to be ring-fenced. I mean, that has obviously been rejected, but there's a whole host of issues, quite new issues and quite sensitive issues that are going to really impact on how we do business in the future. And what we've tried to do this afternoon is to give you a number of snapshots, but really to start the ball rolling and to really put, I think, a lot of what we will be discussing very much in the real context. We have a very eminent central banker. I warned him earlier on today that we don't usually have economists at the Institute of Advanced Legal Studies, but it's our great privilege to make an exception in having Professor Arthur Grimes here this afternoon. As the High Commissioner said, Arthur was, until very recently, Chairman of the Board of Directors of the Reserve Bank of New Zealand, the Central Bank of New Zealand. But he is a very eminent economist. He holds a number of academic positions, including being an adjunct professor at the University of Auckland. He is a member of the Financial Markets Authority Board of New Zealand, which is broadly the equivalent to our Financial Conduct Authority, but it's got a little bit more than that, hasn't it? I mean, you don't change the deck chairs as much as we do.
No, we choose the colours of them.
Yeah. And it's a great honour, I think, for us at London University that Arthur has been a visiting fellow and indeed visiting professor at the School of Advanced Study of the University of London. So Arthur, without more, welcome to the Institute.
Thanks very much, Barry, and thanks, Lockwood. Well, it's a great pleasure to present this lecture here at the Institute of Advanced Legal Studies. As most of you know, it's a constituent institute of the School of Advanced Study, and it's the School of Advanced Study that's hosted my visit to London with very nice offices in Senate House, just along the road. So this paper is the fourth paper in a series on central bank topics. The first three have dealt with inflation targeting, exchange rate systems, and macro-prudential policies. And they are available on, you can ask me later how you can get hold of those, but on the MOTU website, which is one of my research positions in New Zealand. The four lectures have been informed by 26 years experience as a central banker. First as a staff member, I was on the staff for 15 years, ultimately as chief economist, and then I left for 10 years, and then came back for 11 years on the board, last 10 years of which has been as chair. But as I should stress, I left that position in September, so all my remarks today are purely in a private capacity. As Barry said, I'm also on the board of the Financial Markets Authority in New Zealand, which is similar to the Financial Conduct Authority here. And that's been very interesting because I come across issues of responsibility and accountability, or irresponsibility and lack of accountability in the financial sector from a different angle, but one that's complementary to what I've seen at the Reserve Bank as the banking supervisor. And again, I'm not speaking on behalf of the FMA. In this lecture, which is essentially on micro-prudential and related policies, I'll reprise some of the themes from the macro-prudential lecture, so apologies to anybody who's attended both. But I'll also develop further the key theme from that lecture, that policies in the financial sector need to be structured to internalise the risks within financial institutions, rather than having those risks borne from outside, and especially outside ultimately by the taxpayer. So just in terms of the outline for the talk, I'll talk a little bit about banking risk, and this goes across any kind of deposit-taking institution, the implications of those risks, typical regulatory responses and the implications of those. One of the themes will be that often in doing regulatory policy we can make things worse rather than making things better. And it's really important to look at the implications of regulatory responses. And then I'll have a few concluding thoughts. So, what are the types of banking risks that we might want to consider, or for that matter, any kind of deposit-taking institution? Banks and other deposit takers are subject to a number of key business risks. Of course, credit risks are a key component of traditional banking, being the risk that the borrower may not repay the loan plus interest in full when it comes due. And a central function of financial intermediaries, whether they're banks or other deposit takers, is to undertake ex-ante credit checks regarding the viability of the business or the asset on which they are lending. As well as standard market risks affecting loans, there might be some macroeconomic type risks, banks face two additional forms of risk when they're making loans. The first is that banks make loans to borrowers who may end up earning the required return on their investment to repay the loan, but who hide the returns in such a way that they claim they cannot repay the loan, as per the contract. Now, this is a classic moral hazard problem, which can be mitigated by the bank by ex post monitoring of impaired loans. So somebody comes to you and they say, we can't repay the loan. You then use your loan officers to go and check them. It's a costly exercise, and so clearly there's costs involved in this part of the financial intermediation process. The second form of risk is an adverse selection risk. In this case, if a bank charges a higher interest rate for its loans, because it sees a riskier environment out there, unfortunately for the bank, the worse the pool of potential borrowers becomes. And why is that? It's because investors in reasonably safe but lower return ventures will drop out of the loan market because the interest rate's gone up. So you're left only with those borrowers who are prepared to have a risky venture that can, if it pays off, will pay a higher return. So you have this problem that if you try and raise your interest rates to account for risk in the markets, you actually can end up with a riskier set of loans. And this source of risk requires careful and unfortunately again costly ex-ante monitoring of loan quality prior to approval. So these risks combined mean that banking is a specialised business. It's a business that requires well-resourced and capable analysts. Furthermore, there are economies of scale in processing this information. The more information you've got about some loans, the more information you've got when you process an additional loan, because you've got more background on it. Thus, in the absence of regulatory restrictions, the pool of banks in most countries is small, and that gives each bank a degree of market power. Now that presents a potential problem, obviously, for the competition authorities, but that's not going to be the focus of my concerns today. That's a completely different sort of set of economic issues. So what are the implications of these different types of banking risk? Rather than the competition issues, which I'm not going to focus on, for me a greater concern comes from the fact that a limited pool of large banks means that each bank is a major economic player, and so wields considerable power over officials and politicians, and failure of any large bank can have macroeconomic consequences. Now, I make that claim about having power over officials and politicians from experience. Okay, I well remember a prominent Australian banker who we were dealing with when we were trying to change some regulations that would have affected this particular bank, saying how much power they had, not just over the existing government in Australia, but also over the opposition party. In fact, that basically they had sort of power over both sets of politicians. It didn't matter who was going to win the election. He was correct. A large bank failure affects all its customers, either by virtue of being a depositor who may lose money, or by virtue of being a borrower who may not be able to roll over a loan. Because of the information-intensive nature of loan giving, it's not always easy for even a sound borrower to switch banks at short notice if a bank has trouble refinancing the debt. So even if you're a sound borrower, a bank failure obviously can cause you problems even though you're not a depositor in the bank. But the problems extend much further than just the bank's own customers. A bank failure, especially if accompanied by a macroeconomic shock, may cause other banks to become risk averse and to shore up their own balance sheets by cutting loans to more risky borrowers and to enhance their own liquidity. So this has the consequence of magnifying any initial shock that's already come through to the economy and could potentially cause a major recession, as we've seen with the global financial crisis. Okay, I mean, we have many recessions over history, but only very few of them become major depressions or close to major depressions, and they're almost always associated with a set of banking failures. The situation can of course be exacerbated by a prior credit boom with excessive leverage in the financial sector, which leads to excessive leverage in the private non-financial sector. And excessive leverage may be accompanied by an erosion of credit standards by lending institutions in the face of competitive pressures. In turn, those competitive pressures may be magnified by misaligned incentives, which may be in the nature of high short-term bonuses for bank management and directors, or may be simply considerations of job preservation or job promotion prospects within the bank. So even without the bonuses and all that sort of peripheral stuff, there'll still be the same incentives to compete because you want to get a better job. The potential for a credit-fueled boom may also be exacerbated by banks' easy access to short-term wholesale funding from domestic or international sources in normal times. And of course, this source of funding, as we've found out, exposes the individual bank and the system as a whole to liquidity risk in the event that wholesale capital markets face a sudden stop, as they did, for instance, after the Lehman Brothers collapse. So even very sound banks, say in Australasia, could not access credit because the whole world's wholesale financial markets dried up. In recent years, the potential scope for these risks to spread beyond the core banking system has been compounded by the originate and distribute model of banking, whereby banks perform the initial credit checking role, they then package and distribute securities and vehicles for other institutions to hold. And of course, the more leveraged these instruments are, the greater the risks. Failure of the underlying assets, perhaps reflecting poor credit checks in the first place, then compromises the integrity of a range of institutions, and not just the institutions that made the initial loan decisions to start with. Now, firms in many industries face risks that management and boards are expected to manage without recourse to any government-stipulated risk management policies or regulatory overlays. However, the ability of a banking collapse to have macroeconomic effects which spread beyond the collapsing institution means that policymakers and governments cannot ignore the soundness of banks, unfortunately. So that takes us to the regulatory response side. The Basel III framework for bank regulation, which I'm sure most people here know about, is designed to lessen the risks to banks and to make them more resilient in the face of shocks. Key features of Basel III include increased bank capital requirements, including the potential for a counter-cyclical capital buffer, a minimum leverage ratio, a liquidity coverage ratio, and a net stable funding ratio. So essentially they're looking at the bank capital side and the bank's liquidity and funding side. Incorporation of these features mean that a bank is less likely to collapse, firstly if credit losses rise as a result of a recession, and secondly if funding markets dry up as a result of a global liquidity crunch. And as an example of the latter, the Reserve Bank of New Zealand a couple of years back introduced a core funding ratio, a minimum core funding ratio, that requires banks to fund at least 75% of their total loans and advances by long-term wholesale funds or retail deposits plus equity. So they can't rely too much on short-term wholesale funding, essentially, which they used to. Incidentally, in terms of ongoing conversation in the prudential literature, one aspect of Basel III that the New Zealand authorities decided not to adopt is a minimum leverage ratio. Now, Andy Haldane and Vasilius Madouras from the Bank of England had a very nice paper called The Dog and the Frisbee, which many of you might have heard of, and if you haven't, you should read it. It's an excellent paper. They showed that complex regulations are problematic, and I agree with that point. But unfortunately, the simple nature of the leverage ratio actually may provide a poor incentive for banks in cases where the leverage ratio is the bank's binding constraint. And if it's not the bank's binding constraint, then it's irrelevant. Where the leverage ratio is the binding constraint, there's actually an incentive for the affected bank to shift to a more risky portfolio of loans, so to increase their profitability for a given level of capital. And that seems to be at odds with the aims of a normal bank regulatory regime. Why would you want to encourage banks to shift to a more risky portfolio of loans? So that's the problem with the leverage ratio. But broadly speaking, adoption of enhanced capital buffers with a counter-cyclical capital element and minimum liquidity and funding requirements make sense given the externalities that banks otherwise fail to internalise as a result of their lending and funding decisions. So with these extra buffers, the question arises as to whether there's any further role for governments in regulating banks. The business of banking, which includes maturity transformation and the credit origination process, means that banks are fundamentally illiquid in the event of a crisis and may be subject to insolvency if a bad enough recession occurs, accompanied by massive business failures. I often have to get this through to my regulatory colleagues who come from a legal background, that essentially all banks are insolvent at all times. Okay? If everybody decided to come in and get their funds tomorrow, banks could not repay. And it's difficult for regulators with a legal background, when somebody falls into that situation, to understand that this is actually a normal situation for banks. They just have to cross their fingers and keep them crossed that that doesn't happen. But if buffers are so high as to completely preclude the risk of bank failure, banks cannot realistically fulfil the vital intermediation function that they perform, which links borrowers to lenders, and obviously increasing the country's productivity. So we need them to be in that situation. Crisis resolution policies are therefore an inescapable part of a central bank's regulatory task. The IMF, for instance, sees crisis resolution of banks as a key central bank role and argues that credible resolution regimes can strengthen market discipline by reducing incentives to take excessive ex-ante risks. And that's an analysis that I certainly agree with. One wants to reduce the incentive to take ex-ante risks by banks. Interestingly, the IMF goes on to state in this document from this year, quote, "The management of crises may require monetary easing and emergency liquidity assistance by the central bank, the effective resolution of failing banks by dedicated resolution or deposit insurance agencies, and potentially public guarantees and capital support by the fiscal authorities." End of quote. Now, this view, propounded by the IMF and followed by many central banks, may, I believe, compound the ex-ante issues that arise from banks failing to internalise fully the risks of their own decisions. And this brings us to the issue of misaligned incentives on bankers that are created by central bank and government policies. So let's look at the implications of the typical regulatory responses we see in financial markets. Realistically, no matter what ex-ante micro-prudential policies are in place, lending institutions will always have the potential to lend excessively to agents to enable them to make asset market purchases, especially during an economic upswing. The literature now argues that intense competition can induce bankers to lend excessively. But this argument is incomplete, surely. Firstly, economies of scale evident in banking suggest that the industry itself is not highly competitive. This is confirmed by the very high rates of return on equity that were earned by banks for a very prolonged period prior to the GFC. If it had been a highly competitive industry, we would not have seen those very high rates of return on equity. Instead, the competition, I would contend, appears to be between bankers, possibly due to personal incentives based on market share, bank profits or bank share prices, or possibly just based on ego. Furthermore, many competitive industries, whether it's supermarket retailing or logistics, do not see similar degrees of excessive risk-taking. And the reason for this is that there is no one beyond the company's own stakeholders who is underwriting the risks that are taken by the firm's management or directors. Banks and some other financial institutions are different. Following the end of the Great Depression, governments have tended to stand behind banks, and especially bank depositors, and sometimes even other bank stakeholders, bondholders or equity holders, in the event of failure. The provision of deposit insurance is one aspect of this government support. Past bailouts for stakeholders, often extending, as I said, beyond depositors, magnify the ex-ante degree of expected state support for banks. This behaviour by governments alters bankers' incentives to take on additional risk, since the banks do not have to compensate bondholders and depositors fully, or at all, for the extra risks that the bank is taking on. But how necessary is such government support, and what are the economic costs of providing this support? Consider a case where a bank is potentially subject to imminent failure. An effective policy response is to invoke suspension of convertibility immediately a run as apparent, so you close the bank down immediately, temporarily haircutting deposits and converting that haircut into equity. So you might have $100 in the bank, suddenly $30 of it is converted into bank equity, and you've got $70 left as a deposit, $30 as equity, or whatever the market value of that $30 is. And this provides a liquidity and a capital buffer for the bank to continue to operate. And one keeps the haircut in place until such time as the probability of a run is dissipated. The haircut can be structured in such a way that some de minimis level is not subject to a haircut, so that all depositors have access to some working balances immediately the bank is reopened. And the existing deposits that are not haircut, they are guaranteed, but only those portions are guaranteed. This type of policy, incidentally, was used successfully in one run on a deposit taker in New Zealand in the early 1980s. It was to a society called the Public Service Investment Society. And it underlies the recently introduced Open Bank Resolution Scheme, or OBR scheme, of the Reserve Bank of New Zealand. With the OBR scheme, once the haircut has been made, the remaining deposits in that bank are guaranteed, so there is no incentive to run on the bank. In fact, those will be the only deposits in the system that are guaranteed. As Meyer Cohn, a famous monetary scholar, has documented, suspension of convertibility was a regular occurrence in medieval banking, even in Venice, for instance, in the early 16th century, where runs on banks were common because in those days the only liquidity was available was through gold, and gold wasn't particularly liquid. The key difference between deposit insurance, as is typically provided today, and the open bank resolution approach is in the allocation of risk. Depositors face some risk under the OBR approach, and so will factor this into the deposit rates demanded from banks. By contrast with depositor insurance, the depositor faces no risk, and so bank management is freer to take greater risks for greater return to themselves and their shareholders without having to pay a risk premium on their debt. To the extent that bondholders also expect some government support, the situation is obviously worsened. So it's little wonder that the banking system takes excessive risk and is able to internalise the resulting rewards. Meyer Cohn's analysis of medieval banking provides some other clues on potential ways to reduce the moral hazard that enables bankers to expropriate the private rewards from the provision of public sector insurance. Medieval bankers were required to provide an oath that all funds would be repaid. The oath was potentially subject to the death penalty. And as one example, in Barcelona in 1360, Francesc Castello was beheaded in front of his failed bank. Quite a poignant moment, one imagines, especially for Francesco. Bankers also faced, of course, because it was an oath, they faced eternal damnation if they failed to adhere to their oath. They also had to provide surety in the form of real property or guarantees by third parties. And in Venice, for instance, bankers faced unlimited liability, and interestingly in New Zealand, double liability on one bank's shareholders was only finally abolished in 1965. The issue of bank risk associated with loan quality and liquidity issues was analysed long ago in the 16th century by Tommaso Contarini, who argued that there was an inevitable conflict, as there is today, between the public's need for a stable banking system and the need for private bankers to make a profit while tying up funds in illiquid investments. One way around this conflict, at least for depositors who wish primarily to place their funds in a purely safe bank, was the creation of a public bank, which just accepted deposits and invested those deposits in loans to the government, for instance. And two such banks were created, one in Barcelona in 1401 and one in Venice in the 16th century. The only problem there is that you then got another problem, which of course is that the government then wanted to get its hands on all this money, and there was another moral hazard problem. But it's interesting, the creation of that type of bank precedes by 600 years the recent calls for the creation of similar sorts of banks in the modern world post-GFC. So problems of moral hazard in banking relating to both risk-taking and liquidity management are not new. Furthermore, there is a range of solutions, or at least partial solutions, that could be implemented if there's a willingness on the part of authorities to do so. More imaginative regulatory requirements could be used to underpin a more effective market-based supervision process. A well-known problem of the banking industry is that equity holders have unlimited upside risk to returns, but only limited downside risk, where the limit is to the value of the equity they have in the business. Incentive contracts tend to align management's distribution of returns with that of equity holders. Depositors, who are less well informed than management and equity holders, have zero upside risk to the returns, because they've got a deposit contract, not an equity contract, but it causes sizable downside risk to the extent of their deposits. Thus, there's an asymmetric incentive between equity holders and debt holders to take risk. This asymmetry exists for other firms as well, of course, but the distinguishing feature of the banking system is that debt providers are typically forced by circumstances to deposit with at least one bank, and they're small. Their depositors are small. They do not have the incentives or the resources to monitor the bank's soundness. This is the classic problem with banking. Non-financial corporates, by contrast, often have loans supplied by large professional debt holders, whether they're banks or corporate bond, etc. So one possibility that can more closely mirror the non-financial case within the financial system that I wrote about in the 1990s, well before the GFC, was for the authorities to require banks to have at least one large subordinated debt holder, where large is defined in relation to the bank's balance sheet. The subordinated debt holder, who like the depositor has no upside risk, would have no expectation of insurance and effectively be the vehicle that has to accept any haircut on its holdings in the event that the bank becomes insolvent. As a result, the subordinated debt holder has an incentive to monitor the bank closely and would charge the bank through the rate on its subordinated debt for this activity and for the resulting risk, in the same way as a large bondholder does to normal non-financial corporate. Interestingly, this option was studied by the Board of Governors of the Federal Reserve System in 1999, and was also analysed by the Shadow Financial Regulatory Committee in 2000. Calomiris, a famous American scholar on financial institutions, indicates that its potential adoption in the United States was killed in 1999 by bank lobbying. But he argues that the mechanism still merits reconsideration. That it's a classic situation where any moves to internalise the risk to banks is often unwound by the lobbying of bankers to make sure that this doesn't occur. Since the GFC, a similar idea has emerged, of course, in the shape of contingent convertible notes, or COCOs, that are bonds which convert to equity contingent on a specified event, such as Tier 1 capital of a bank falling below a certain level. So a mandatory tier of COCOs, perhaps of a similar magnitude to Tier 1 capital, would provide a capital buffer over and above existing capital ratios. Another possibility to reconsider is multiples, such as double liability on shareholders. This was once the norm in banking, not just in medieval Europe, but also in 19th century Scottish banking, for instance. It became disused owing to a number of problems. One problem, which I think was common in Scotland, was the ability to disguise beneficial ownership of the bank through the use of nominees, or in particular through the transfer of shares to penniless owners just prior to collapse. So if you had double liability, you made sure you sold your shares to somebody who didn't have any money, so when it came to double liability, they couldn't pay up anyway. Now, modern share registers may be able to handle some of the nominee issues, but to the extent they cannot, there may still be a role for multiple liability in the case of cross-border subsidiary banks. Interestingly, in New Zealand, we force all cross-border banks of any size to be subsidiaries, not branches. And those subsidiaries have to have a domestic board, which has a domestic chair, a majority of non-executive domestic independent directors, and obviously they're subject to the same capital requirements, liquidity requirements, etc. That is all other banks. So in these situations, for instance, the parent bank could be required to have double or greater liability for the subsidiary bank. So at least you know who the parent is in this case. You don't get those same problems as the old Scottish banking system. Modern Scottish banking system isn't too hot either, but anyway. Now the common theme behind the mandated large subordinated debt holder, the mandatory COCO issuance, and multiple shareholder liability regulatory options is that there is at least some private sector agents standing behind depositors. And importantly, these agents stand well in front of the taxpayer in the queue to cushion depositors in the event of bank failure. A complementary and, in my view, highly effective approach is to mandate regular disclosures of specified information by banks and to hold bank management and or directors accountable in the event that the disclosure is inaccurate. This system is used in New Zealand and has been used for the last 15 years or so. There's a whole host of disclosures that have to be made, the typical sort of accounting data and things like that, but also one of the required disclosures to which all bank directors of a New Zealand incorporated bank or the chief executive of a foreign incorporated bank, for a small bank, that they must attest to is that the bank has appropriate risk management policies in place. And for instance, I've got an extract here from the Bank of New Zealand's quarterly disclosure statement this year, which said, quote, "The bank had systems in place to monitor and control adequately the banking group's material risks, including credit risks, concentration of credit risk, interest rate risk, currency risk, equity risk, liquidity risk, operational risk, and other business risks, and that those systems were being properly applied." Now, criminal liability exists if a director or chief executive signs a disclosure statement that includes information that is false or misleading. Okay, so that's in the Reserve Bank of New Zealand Act, Section 89A for the lawyers. Now, if convicted of having a false disclosure, an individual who commits an offence is liable to imprisonment. So the directors are liable, each director is liable to imprisonment. Civil liability also exists for the directors or chief executive, where the bank fails following an inaccurate disclosure statement and a loss for depositors or bondholders ensues. There are a very limited number of admissible defences allowable in the Act. One of these is that the individual, quote, "had reasonable grounds to believe and did, up to the time of the subscription for the securities, believe that the statement was true." And no doubt this would be a matter for great legal debate in the event of a bank failure. Now, I note that the United Kingdom is considering introducing legislation that would make reckless trading by a bank an offence. While worthy of consideration, there is a slight problem in this option, in that what is viewed as reckless ex post may not have been viewed as reckless ex ante by most observers at the time. Also, I think a bigger problem is that reckless trading is only likely to be punished in the event that the trading actually caused a bank to fail, rather than when it led to high profits because the reckless bets paid off. So year after year after year you can trade recklessly, the bets paid off, and no one thinks to take the bank to court because of reckless trading. My preference is to make the disclosure requirements and the attestations on appropriate risk management policies continuous, so the judgments can be made on an ongoing basis as to the veracity of the disclosures. And interestingly, using data from the 1932 Chicago banking panic, Calameris, which was the onset of the Great Depression, really, 1932, not 1929, this is what really caused the Great Depression to become great. Calameris and Mason used data to show that even without mandated disclosures, other banks could make distinctions between the health of individual banks in terms of whether to support other banks or not in the event of a run. But mandated bank disclosure statements that can be readily compared and reported on by the media enhance this ability to monitor banks. Coupled with the existence of criminal and civil liability for misleading disclosures, the regime is very effective in focusing directors and chief executives' minds on adequate monitoring, control and disclosure of all risks. And here I was talking to the lead partner in one of the major 3 accounting firms in New Zealand who dealt with financial institutions. He used to sit on the audit committee of all the banks, major banks in New Zealand. And he said that this particular disclosure statement requirement exercised their minds more than anything else, because they knew there was criminal and civil liability if their disclosure was inaccurate. And personally, I was once chief executive of funds management arm, essentially a subsidiary of Lloyds Bank, that well-known successful UK bank. And when it came to this disclosure situation, the accent would be put on me to make sure, because it was a subsidiary of a bank in New Zealand, that this disclosure statement was absolutely 100% correct, because of the penalties that are involved if it was not. The mandated quarterly bank disclosure regime has close parallels, of course, to requirements for prospectuses under securities laws. A prospectus must be full and accurate at the time of the prospectus issue, and it must be full and accurate at all times for continuous issuers. It is not uncommon to see cases brought and won against issuers who have inaccurate prospectuses in the market. And a similar standard of disclosure should be required of banks at all times for the same reasons that we require prospectuses to be accurate. Many banking systems have not placed such stringent ex-ante requirements on bank directors or chief executives. And with the record of bailing out bank depositors and others, it's not surprising that many banking systems are rife with moral hazard and excessive risk. But there is an additional source of moral hazard emanating from central banks that exacerbates these problems. I'll give one example. Experience showed investors that the Federal Reserve Bank used accommodative policies to avoid real sector fallout following the 1987 share crash, the Russian debt crisis, and following the collapse of LTCM in 1998. Now, shortly after the intervention following the LTCM collapse, the US General Accounting Office wrote in an answer to a Senate investigation, quote, "Any type of intervention creates the potential for increased moral hazard. Some industry officials said that the rescue would encourage large financial institutions to assume more risk in the belief that the Federal Reserve would intervene on their behalf. The Federal Reserve's involvement has raised concerns among some that the too big to fail doctrine has been expanded. If companies believe that the federal safety net has been expanded, it may encourage more risky business practices." Now, it's important to stress that this statement was made immediately after the LTCM intervention. This was written in 2000, not with the benefit of hindsight after the GFC. The moral hazard incentives being created by the Federal Reserve were obvious to the accounting body, and of course were interpreted as a positive signal by risk-taking investors, but were apparently not at the forefront of the Federal Reserve's concerns. So this is very clear. This is 7 years before the global financial crisis. Subsequent to LTCM, the Federal Reserve reacted to protect the economy after the dot-com bubble, and so the Greenspan put was even more firmly in place. Households, firms, banks and hedge funds duly leveraged themselves, moving further into speculative investments, subprime mortgages, CDOs, etc., that eventually failed spectacularly. The response, supported inter alia by the IMF and other supranational bodies, has been yet more central bank intervention to prop up asset prices and allow over-leveraged banks access to cheap funding. Interestingly, Michael Bordeaux, a great economic historian, in late 2000 summarised the events and many of the causes of the global financial crisis. And he takes a very historical approach, which is important to understand how crises occur. He shows that financial crises are neither rare nor inexplicable. But he shows that the United States has been the progenitor of many, not all, but many of history's major international financial crises. Just this year, in fact, very recently in an article in Foreign Affairs, Kalamiris and Haber have analysed the political economy of banking across countries. They document that the United States banking system has undergone 14 major crises in the past 180 years, in contrast to neighbouring Canada's 2. They argue that the populist political system in the United States, initially dominated by agrarian interests, which resulted in small-scale banks, and latterly by urban forces, which has resulted in support for loans to citizens seeking mortgages, ultimately leading to the subprime crisis, has been behind the poorly structured and poorly regulated banking system in that country. They argue, quote, "A country gets the banking system it deserves, one consistent with the institutions that govern its distribution of political power," end of quote. It's no wonder that the United States is the progenitor of so many international financial crises, given the dominance of certain political elites in that country, that it has resulted in the United States authorities elevating moral hazard in banking to such high levels. Now, to their credit, during the GFC, the United States authorities, while unfortunately bailing out some institutions initially, such as Bear Stearns, finally did a major institution, Lehman Brothers, collapse. The refusal to bail out Lehman's was a courageous and, in my view, finally correct decision for promoting long-term financial stability, even though it caused some short-term problems, clearly. Now, since then, we've seen several settlements whereby institutions that have been accused of transgressing various regulations, e.g. market manipulation, have been punished without necessarily admitting wrongdoing. I won't go into individual cases here, but as we've seen cases, for instance, where an institution pays, say, $1 billion US to settle all outstanding charges, does not admit culpability, and its executives walk away without explicit punishment. What do these settlements really entail? Money is not paid by the executives or directors. It's paid by the shareholders, who are not the decision makers at the time of the alleged transgressions. The shareholders lost money because of the decisions of these managers, and now they have to pay up again to pay the fines. The people who are the decision makers use other people's money to prevent their own culpability being tested in court. Now, such behaviour would occur in countries that rank well down Transparency International's Corruption Perceptions Index. We would label this a corrupt or a crony capitalist process, albeit without officials benefiting in any way directly from the settlement. One can only speculate, but if the chief executive of such organisations had the choice of spending $1 billion of shareholders' funds or spending 1 year in prison, how would the ex-ante incentives to engage in and monitor such activities have been altered? The New Zealand regime of required disclosures with criminal liability subject to imprisonment for transgressions, plus civil liability, is, I contend, a much stronger deterrence against malfeasance and inappropriate risk-taking and disclosures than is the fear of having to pay over somebody else's money if caught. So some concluding thoughts. In my view, macroeconomic stability as well as microeconomic and firm-specific outcomes is placed at risk by the raft of moral hazard-inducing policies of central banks and governments that are enforced today. As I've outlined in my previous lectures, governments and central banks foster asset price booms through their willingness to accommodate booms with low ex-post real interest rates following the crisis. They also foster excessive risk-taking through their willingness to support individual institutions and their funders in the event of failure. The incentives for bankers to take risks that are socially suboptimal need to be altered by internalising the cost of failure to the decision makers. Regimes such as required bank disclosures with criminal and civil penalties for supplying inaccurate information are an excellent start. These requirements put similar disciplines on bankers as faced by issuers in other securities markets, and the penalties for transgression should be at least as severe as faced by agents in those markets. I should make it clear here that I'm not calling for penalties for bank failure per se. Okay? Banks will fail, and they may fail for very sound reasons. Bad luck, whatever. Appropriation by the government of the assets or whatever. The maturity, transformation, and credit provision role of banks means that even a well-run bank, having made proper disclosures about its risks, may in extreme times fail. The penalties should be reserved where banks fail to disclose the risks that they are undertaking, whether or not they fail. Without going into detail, I note this distinction was evident in New Zealand, where a number of deposit-taking institutions that were not registered banks failed following the global financial crisis. Only some of the directors and or executives of failed institutions were prosecuted under securities laws, and partly reflecting the differing nature and different quality of prior disclosures. Also necessary are requirements for private sector agents, such as existing shareholders or large subordinated debt holders or COCO bond holders, to stand behind depositors in the event of a bank collapse so that taxpayers do not have to do so. Enforcing private sector disciplines on banks and other deposit takers means that the benefits of current explicit or implicit taxpayer support are not captured by bankers and bank shareholders, as they have been in the past. Most importantly, however, the enforcement of private sector discipline will ensure that the pricing of the support is correctly reflected in the market cost to banks, which will increase as risks increase. Ultimately, a combination of these regimes, if adopted, should see responsibility and accountability in the financial sector being sheeted home to where it belongs, within the sector itself. Thank you.